First off, congrats to everybody who made the list. I think it's a great achievement. The list issue is always my favorite issue of Alberta Venture each year. One of my great regrets in business is never cracking that #1 spot. #2 2 years in a row, but life goes on. What struck me with the list this year is the dichotomy between the big publicly traded oil and gas companies and the mid-market, the small mid-market kind of startups. It's that perfect, I think there was an article about this in the magazine actually that touched on, it really represents Alberta, these two type of economies that we have, but both inherently entrepreneurial. So Ruth, when she called me up, asked me to come and tell my story. Tell how we created value in Investopedia. And so to give you a little bit of background in terms of where I want to go with this, I know as, and I can consider myself an entrepreneur first, I don't really love when people tell me how to run my business. And I'm guessing there's that sentiment with a lot of guys in the room. That everybody here knows the basics, they've had a lot of success, they've done amazing things. You know, my spin on this is just to share some experiences and kind of give some of the inside scoop in terms of how our business worked, and hopefully give that little nugget of information that, you know, sometimes you're talking to another business owner, sometimes it's in a presentation, it's that, like that inspiration, that insight that you get, that like aha moment that you can take back and then actually implement in your business. So I've got you know, 10 areas that worked for us. And if I can leave, you know, 1 or 2 of those ideas with you, then I'll have done my job. And before we get on to Investopedia, let me just back up with this scope of the conversation. Value can be a nebulous term. It can mean a lot of different things. There's the financial side of it, whether you measure that in profit or EBITDA or whatever type of owner earnings you want to measure, the financial, but it really means cash in your pocket. And then there's this other side of creating jobs, building your community, lifestyle, any of the softer side. So I just kind of want to get the pulse of the room. In your businesses now, what is the primary driver? What do you interpret as value? How many people, by show of hands, would be that financial side? And what about, and then on something else, we definitely didn't have all the hands then. Who else would identify with something else? Something other than value? And maybe shout out, what is that? Brand? Culture? Very cool. Okay, very good. It's, for the purposes, I think that there's so many different ways that you can calculate this and measure this, and no way is right or wrong inherently, but I will say that for our experience, we usually use that financial metric, that, you know, profit in the bank. And so to not offend anybody, but just to clarify, you know, when I'm talking about value, we usually viewed it with that sort of a lens. So Investopedia was, as we mentioned a little bit, a website related to online education, content, and tools for the individual investor. I started it with a friend of mine, Cory Wagner, back in '99. We were both still students at the U of A, taking our BComs. Cory Wagner, I called him Wags. We met playing hockey, so those hockey players in the audience can probably identify with the nicknames, just, you know, the really creative nicknames based off the last name. He was Wags and I was Janner. Kind of helped with both being Corys. This was back in '99 at the height of the .com boom. Everyone wanted to start a .com. You just threw .com on the end of something and you could make a bunch of money. So we kind of figured that would be a good idea. We want to start up a website. We're both stock geeks, so we said, okay, there's something there. So after studying and after we're done studying, we'd head up to RAT, which is, for those who know the U of A, bar up in the Students' Union building. It wasn't quite as cliche as on the back of a napkin, But we'd kind of sketch out, we'd flip through. Back in those days, there was this publication called Red Herring, which a magazine was like the Bible of all things tech. There was Business 2.0, and we'd flip through and look at all these great models. And so we started sketching out what would be the biggest, best, baddest investment website. When we got to a more sober state in the coming weeks and sat down to actually start working on it, we realized we didn't have the resources or the skills to necessarily take on all that. So instead we focused on this one little piece. We figured, let's take this investment dictionary and build that out, because we knew in 6 months or in a year's time that would still be valid and we could get to the rest of the fun stuff. As it turned out, we never actually got to anything else. That dictionary turned into a focus around education and educational content and tools, and we'd stumbled upon this niche that served us fairly well. Part of the reason before that is that no one wants to do education. It's just not sexy. Everybody wants to write about the latest earnings, the latest earnings news from Apple, or what Facebook's doing, or what is the iPhone going to look like. That sort of sexy side of journalism and media. Everybody was doing that. You had 10 sites on this side, and we were on our own. And that really helped us well with the advertisers afterwards, because it gave you the ability to target everybody from retirees to active traders to guys that were really self-directed. Our main clients we're going for were all the big US brokerages. We're going for the Charles Schwab's, E-Trades, Wall Street Journal was a big client, all the big American brokerages that were trying to get in front of people that wanted to be more independent with their investing. So we started the site in '99. I can remember getting this phone call. I was still at the U of A, just left class, and Wags called me up and he said, "Cory, we're on CNBC. We're their site of the day. There's like thousands of people on the site." And so you had this moment where you said, well, maybe this little side project, maybe we got a business. So we formally incorporated in February of the next year, which was auspicious timing for those stock market geeks in the crowd. The peak of the NASDAQ was within a month of our founding, or of our incorporation date. And so it's probably the worst time in the world to start an internet company, or especially a financial one at that. But in hindsight, maybe a little bit more dumb luck in that it made us focus on the cash flow, those kind of business fundamentals. If we'd raised money, I don't know if we'd be the same entrepreneurs that we came into, because in those early days, it was Wags and I in a 454 square foot office in downtown Edmonton, the big pole in the middle. You just made do with whatever you had. For those in real estate here as well, that rent in 2000 was $8 a foot in downtown Edmonton, so things have changed a little bit. Over the years then, we picked up another partner by the name of Tom Hendrickson. He came on. Tom actually had a great, as an aside, had a great write-up here in Alberta Venture last month. Tom just raised $8 million and is going out and kind of trying to acquire a bunch of other financial websites, which $8 million down here in Calgary in the oil patch might not be that big, but on the tech side, it's really good that we're actually building that ecosystem out, and on the internet side, it was a pretty good raise. So Tom came on back then. We kind of went through, did the Alberta Venture list a couple of years, basically just tried to keep on growing 100%, just kind of doubling, eventually getting bigger and bigger, probably not unlike a lot of the stories here. And then we sold to Forbes in 2007. So I'll get into detail on that in a little bit. So there's my short history. If I look back on it and the experiences, I would break down how we created value into two areas. On one side, we've got this fundamental side, the how to make money the old-fashioned way, how we improve our businesses. On the other side was aspects related to the deal. So I'll first get to the fundamental side. Number one on that list would be recurring revenue. I love recurring revenue. And I look at Carlos Slim, the richest man in the world, the Thompson family, richest family in Calgary, the Shaw family here down, one of the richest families in Alberta. They all had this subscription recurring base built into their business somehow. And I get it, like if you're in telecommunications or cable business, you're inherently a subscription basis. But what we tried to do is we took advertising, a business that's not necessarily subscription, not recurring, and we tried to change it into as recurring as we could possibly get. We would take, and when we approach an advertiser, instead of trying to just maximize how much we sold on any one particular unit, we'd put this overall package together, even leave a little bit on the table, if we could have that long-term commitment. And when I saw, internally at Forbes how this worked, they took it to another level. Mike Smith was the president of Forbes.com there, and when I was seeing contract negotiations with him, it blew my mind how this one I can think of. We were doing a deal with Yahoo, so Yahoo was populating some of the ads on one of our search pages. It was like about a $500,000 a year deal, so we kind of knew it was going to come in around there, but we were trying to play them off versus Microsoft and Google. And I would have gone in and said, okay, how can we just nail them down on this, nail them down on this? This Mike Smith, the guy from Forbes, he took a bit of a different approach. He said, no. We know we can get that, lock that in, and then kind of have some other share on the upside here. So he took what was, it could have been this just volatile revenue stream, locked it down into this recurring annuity that would come through bit by bit every single month. It made it a lot easier when you're looking at the budgets and you can know, you just pencil it in. It's beautiful. So if I think back to the early days, what recurring revenue really did for us was it allowed us to work on other parts of the business. We were the rainmakers in the early days. I mean, we didn't really have any salesperson who was really driving it for us. If we didn't have the ability to actually go out and work on it, if we had to keep on getting something new every single month, I don't think we would have been able to really be able to focus on those other aspects of the business. Number 2, a focus in the US. Now, I don't want to be an unpatriotic guy, but everything we did was geared around the US. From making sure that every employee had a spell check set to US English, not Canadian English, to hiding your accent for as much as you could when you're on the phone. We made a conscious decision from day one to target the US market. And yes, some businesses, again, are easier than others. And the internet is inherently international. But there were a lot of websites in Canada just focused on the Canadian market. So if you looked at the size of Investopedia overall, fewer people knew about us. Our market share in Canada was a lot smaller, but we'd have been bigger than Financial Post, bigger than the Globe Investor. I'm pretty sure we're bigger than any Canadian publication on the business side. And that's not to say that we were better, it's just we were playing in a bigger sandbox. A top 10 publication in the US is just that much bigger. So we'd have a whole, every month it seemed like we'd have another anecdotal conversation, be flying back from somewhere and say, oh, what do you do? Oh, well, I work to site Investopedia, and people, wow, Investopedia helped get me through my MBA, I love you guys. But they'd have no idea we were in Canada, never mind Edmonton, Alberta. So that was fine for us, but 99% plus of our revenue was in the US. And if it was a conscious decision that I think was probably one of the best that we made. The next one on the fundamental side, kind of gearing around competitive advantages, but not in the way that you might be thinking. And we all, you go back to university and you kind of hear these models of, everybody knows the story about Walmart and how they use technology and distribution to drive costs down and they've got the economies of scale. Okay, great. Apple and branding, got it. Patents and big pharma. Okay, there's all these barriers to entry, all these economic moats that seem to work at that high level that I never thought really applied as much when you're in a smaller business. Like when you're in $1 billion business and you're going, it's Samsung versus Apple, yeah, you've got, these laws apply. But there seems to be a lot more gray area to me when you get down into mid-market. So for us, it was around SEO, search engine optimization was one, and then the way we produce content. So on the search side, we, as a publisher, bow to the god of Google. We would use search as an input to the content production process and make sure we were producing content that could get us found on the search pages. And not just any content, but we'd pick battles we could win. So if you Google investing or sales, we weren't necessarily number one. I mean, that's tough to beat Wall Street Journal. But we could be the authority if you Google EBITDA, short selling, CAGR, compound growth rate, earnings per share. And even to this day, if you look, you're probably going to see Investopedia on most of those terms because we really focused on year after year building up that authority. And it's to the point where if Joe Schmo over here creates a blog and say you wrote the exact same thing, you're not going to be able to beat that main site because of the authority that's built in. Call it a soft barrier to entry, a soft competitive advantage. The second was really, as much as I like to think we're innovative and cool and different, really we were low cost as well. The traditional media model is, you hire a bunch of journalists, you put them in an expensive office space in Manhattan, you pump out content, you sell ads around that. That's and I'm exaggerating, of course, a little bit, but that's that Mad Men side of it, right? 10 years ago on the internet, you had Wikipedia and blogs and all this free content. So that's this other side. So you got expensive but high quality versus low cost and crap. We tried to be somewhere right here in the middle. So we'd go out and find experts all across North America who can write on anything that an investor might be interested in. And our litmus test was, as a stock geek, do I like reading this? Does this add value? Is there something actionable about what I'm reading here? So, it was CPAs, it was small hedge fund managers, it was consultants to the brokerage industry. In going out, we built this network of 200 plus contributors all over North America. The staff back at Edmonton, there's only 30, 35 of us back in Edmonton. We were the tech side, we were the editors, we were making sure we maintain that editorial independence, but hopefully at a lesser cost. And I would even sometimes argue that our quality was even better than the big traditional media. But we certainly didn't have their overhead. Number 4 was related to thinking big in terms of pricing. And this was especially true in the early days. We could never really crack the agencies. And if you're in the ad business, the agencies have all the money. Like, you can go direct with some guys, but if you want to go and get a campaign with E-Trade, it's got to be through their agency in Chicago. And no matter what we did, we offered so much value. And I thought, we'd keep on filling out these RFPs. Why wouldn't we get it? So, and this is completely due to Wags, my partner. You might say he had bigger balls than me. You might say whatever. He said, screw it. He just tripled the price. So same amount of ads, tripled the price. Of course, what happens? We get the sale. Now, clearly, we couldn't keep on just tripling the price infinity. Once we figured out the true price in the industry, obviously, then you have to compete on a different level. But in the early days, I think you do whatever you can to go from a couple people to 5 people to 10 people to an established business, and I think we were underpricing ourselves. And if I look out to a lot of entrepreneurial firms, I see the same type of thing, where it's that hard choice to raise prices, especially on existing customers. But if we never did that, we wouldn't have been able to get to that kind of next scale, because it really was a situation where that price, the quality was judged by by the price. You kind of had that nice coexistence there where all of a sudden you're making more money off it, but now you can do a whole bunch more things. So the last thing on the fundamental side was the industry dynamics. My definition of a great business, a great industry, is high returns on capital. We talk about recurring revenue, some of these factors. You can reinvestment opportunities. Sometimes it's easier to look at what's a crappy business. A crappy business is one with super high capex with a commodity-based product. So, like, the worst business in the world is the airlines, right? Now, I know there's always a WestJet that is the exception to the rule, but for every WestJet and Southwest, there's 100 other companies that have gone bankrupt. And if you look back at the actual airline industry, the airline industry has actually destroyed capital over its existence. So from an investment point of view, we would have all been better off if the Wright brothers would have actually never got off the ground. Now, the media business in certain spaces can actually be a great one. So if you own a newspaper from like 1800 to like 1995, that was an awesome business. You minted money. Same if you own a broadcaster back in the 80s, like if you had an ABC affiliate in Wisconsin, it was the best business in the world. You have no competition. But then, of course, the internet comes by, or cable comes by. Technology supplants that distribution system, and so it's like. But the core side of a media business is basically this fixed cost base, no capex, no cost of goods sold, so you can just spin off cash when we went. In the later years, our margins were like 50% net. And we made so many mistakes. And so what I think about that is, yeah, we got lucky and landed in a good business. But it's sort of like Charlie Munger, who's the vice chairman of Berkshire Hathaway, Warren Buffett's right-hand man, who said, pick a business that an idiot can run, because sooner or later an idiot will run it. We always sort of felt like those idiots. We always joke about how stupid we were 3 months ago. Go, man, we were really dumb 3 months ago. And then we were really dumb 3 months ago. And, sooner or later you kind of go, okay. So while in that last, we got lucky in that last one, but as I look going forward, the takeaway that I've learned from that is that anytime I'm involved in the business and putting resources into that, whether that's capital or my time, is this a good business? Because am I really a better manager? As much as we all think we're all superstars, and there are many superstars in this room, but I'm not one of them. I'm one of those guys that I'd like to pick the easy battle, right? And so is my industry an area where I can actually kind of win those battles? And for our case, that certainly, if I'm being honest with myself, was part of our success. So there's the fundamental side. Now, I probably have had more questions from other entrepreneurs on the side of on the deal than anything else. I mean, people always come, oh, so does Forbes just offer you a bunch of money? The whole deal process was probably the most difficult, but most difficult part of my professional life, but also the most satisfying. This roller coaster ride. The reason we sold was twofold. Number one, there's only so much advertising you can sell from Edmonton, Alberta to New York and Chicago. Sooner or later, we were going to have to actually put on a tie and get out from behind the email and go and do that. And we didn't know anything about setting up a US sales force, so that's one factor. Second is we were watching the market and it was getting pretty frothy. If you remember, we had the bust, and then 2007, life was pretty good, right? None of the financial crisis had happened yet, so we were watching and looking out there going, maybe it's time. We had so many phone calls from VCs and PE guys and other investors. So I'm sure everybody in the room has had those same type of calls where you hear and it's like some 22-year-old kid who's calling you up and you can hear him just typing all the information back into the system, trying to get details in your business. And we'd always kind of just blown these guys off. But there was one banker who, I don't know if I'd say he was good, but he was less sleazy than the other ones. And he seemed like he might know a little bit more about the industry. So it was a boutique firm down in Silicon Valley, and so we said, okay, it was kind of a leap of faith, so we signed up with them. The deal process for the first couple months, we were getting your book together and actually getting financials and some semblance of decency. They were calling out, they probably reached out to 40 or 50 different companies, 12 to 15 presentations on the phone where we went through it virtually, a bunch of follow-ups from that, 8 in-person meetings in Edmonton, 3 in-person meetings. They're all the acquirers were in New York. And then we went to exclusive with one and followed through. So it took us a little bit over 6 months to get the deal done. The deal closed April 12th. Wags and I both had our first child within a month before that as well. My daughter was born April 1st. So it was a cool, crazy time. But what I learned from that, and there's 5 things I'll go through here as well. The deal process. The running a good deal. Running a good process, and this is one where we got lucky on. I mean, we got lucky. We got a good investment bank. Number one, it was such a rigorous process that they ran. They kept everybody in line. They set the bankers set expectations for all parties involved. Okay, you're going to need to get this by this date. Hey, this guy's saying here, valuation range might be on this side. Even the meetings in Edmonton, we thought, why are you pushing them to actually fly up to Edmonton? I mean, it's a huge inconvenience. But we learned afterwards that it's that whole old-fashioned emotional connection. Once you've got someone who's seen the office, who's seen the people, who's touched it, they can feel it, they see it's there, all of a sudden there's more of that grab to keep them in the loop. The big media companies, it was hilarious. They'd send up 7 or 8 guys to Edmonton. We had one billionaire come up. That was pretty cool. It was really amazing, all these people walking through our boardroom. And although our staff had no idea what's going on, we had kind of a flip-flop and shorts policy, and then all these suits are walking through. So the cat was sort of out of the bag by then. But number 2, we ran a non-exclusive process the whole way through. And so what I mean by that is a typical deal you'll see. You'll go out, you'll get a bunch of LOIs, letter of intents coming in, that, stuff that's not binding but kind of sets out the general scope of the deal. And then you'll pick one and you try to close. Well, our investment banker did something, some might say risky, but we had created enough of a bidding war where we actually had 3 parties involved that we were actually negotiating sale agreements with. So this pisses off buyers a lot because they're spending money on legal, they're getting more invested, but it allowed us to really play one another off against each other. And it's that old-fashioned bidding war, right? You know, they eventually got in. And that kind of gets on to the next point, and the negotiating factor and having someone on your side who's good at negotiating. My initial thought was, why don't we just do it ourselves, right? Like, I'm an entrepreneur, like, what's the big deal, right? I could sell my house. Why couldn't I sell my business? I know it better than everybody else. You know, it's kind of laughable to me now actually just thinking about how much my mindset would change after seeing the dynamics between having a true professional in there who can deflect things and it sounds funny, but you know that sleazy, you go to buy a used car and you can never talk to the manager, right? They sort of get that play going on where you can talk to the investment banker, but you can't talk to these guys. And you're going to be working with them afterwards, but they can do a lot more things there. We set incentives as well with our bankers so that we knew we could get X. They basically didn't get paid anything for that. They got an average fee from X to here, and then there was this other level that we didn't ever think we'd get, that we said, fine, you pay yourself crazy percentage, right? Far beyond the industry. But it really, I mean, these guys are as capitalistic as they come. They just, you know, it really did drive them and light a fire under their ass to go do it. So the story that I have on this one is one phone call that made us $5 million. And you know, for confidentiality, I can't really get into the stage or who it was, but you know, 1 o'clock in the afternoon, we're here, and then somehow they moved the goal line here. And I actually wasn't even on the call because they were doing the negotiating separately. So it was just amazing that this happened, but it blew our mind where it said, okay, so here's where you say that range of valuations, right? Here's where it really comes into play. You know, if I compared all the LOIs we got like 10 LOIs, our worst one was a third of what we sold for. A third. And this wasn't some fly-by-night company. This was a publicly traded company. You'd all know the name of it. And, you know, well, the CEO must not have been interested enough, kind of said, yeah, whatever, take it or leave it, right? Knowing now that valuation range, the banker said, oh, well, it's half your, you know, real life value, and then half is this fake, not fake, because, and I don't want to give the impression here that it wasn't worth it. We delivered on our numbers. We had a great business, right? We got a fair value, and it was kind of borne out in the market. So I don't want to give that impression at all. But that extra amount didn't come for free. You know, and here was one of the ways that we were able to maximize on it. The next one might seem a little weird. Being able to walk away. Being able to walk away probably, I don't know if you can quantify it. It's not like there was a phone call where I could, like this one, where there's that great example of, okay, here's exactly how much it was. It was such an emotional connection. And I now know, like beforehand I'd see, oh, this guy sold out for $50 million, $100 million, and you know, that headline number really means nothing. That headline number, you don't know, is it cash or stock? What's the earnout? What's the holdback? What's the reps and warranties? How'd they indemnify it? How long they tie these guys up afterwards? There's so many ways where they get you. And even after we went exclusive with Forbes, you know, there were times when you're really pushing back and forth there, and we had to hold our ground. And one of the things we did was eliminating the earnout. So we had holdbacks, but we had the earnout was going to be, you know, 25, 35% of the deal, and we were able to negotiate that away. And I put that, what I would really care, the biggest factor was being able to have the confidence to say, hey, if this doesn't work out, we'll go back to running the business, whatever. There's another part of it, which is dealing with the professionals that you have. At the start of the deal, the lawyer's your worst enemy because he's just wanting to bill hours, you know, and your investment banker is your best friend because he's trying to maximize value. But on the flip side, after the investment banker has got as good a deal as he thinks he's going to get, your investment banker is the worst enemy and your lawyer is your best friend because your lawyer is protecting you in the sale agreement, and your investment banker couldn't care less if you get screwed on that side because he just wants his commission. Being prepared to like fight with these guys back and forth and tell them, well, whatever, you know what, screw you guys, we're out. We're going. And literally we had conversations like that with our own team. Your team's supposed to be there for you, right? And I'm sitting here yelling and having these screaming matches. You guys, I'm paying you $500 an hour to get in a fight with you, right? What's the deal with this? But that walk away saved us. Number 4, the accountants in the crowd are going to love this one. It was tax planning. The best bang for the buck that we got was with the tax planning we did. We got this initial proposal from a big accounting firm, and it was like a 6-figure thing, and we go, what are they doing? And they can't really tell you what they do. I almost view it as like the SWAT team, where they come in the last 2 or 3 days before the deal's going to close. And there's the U.S. sub and the international subsidiary, and then you've got 3 or 4 different companies in, and you get a bunch of new holdcos and a few different shareholders with different interests, and somehow they just, everything, all legit, all stuff that's past CRA, where it's all completely good stuff, but literally, depending on how you want to measure it, 10 to 20 times what we paid them is what we got back in terms of tax savings. Which, the tax side of it was really something that we didn't think about prior in terms of that maximizing value. It was sort of an afterthought, but now that I know, definitely the best guys are worth their weight in gold. And the final one on the deal factor is exit planning. This is one we didn't do at all, and I wish we did. Exit planning, in my mind, my definition of it is anything you do in your business to maximize value. And it's kind of close to heart to me now, because you go through and you feel like, because I almost feel like you're outmatched, like it's this David versus Goliath. It seems like the whole entrepreneurial journey, your employees hate you, your suppliers try to screw you, you're in this deal against a guy who's done 10 the last year and is way outmatched. There's this kind of emotional thing around how, as an entrepreneur, you're on your own for this one. It's so much to the point where one of my new projects is Investopedia is all around this subject of how do you maximize value? How do you learn from what other entrepreneurs have done beforehand so that you don't get caught in that same pickle? So there's two sides to it. I can give you specific examples. One is on the more administrative, and one is more on the fun side and maximizing EBITDA. We kind of pride ourselves in being cowboys. I don't think our budgets were existing. I didn't think our projections, there was nothing to them. If you look back at the contracts, we didn't really realize when you went through, you're going to look at every single contract you've ever signed, and there's that one contract 7 years old sitting in your closet that, technically you can't deal with a deal unless you get the assignment from this guy that you don't know where he is. There's a lot of headache that came through that a pre-diligence process would have helped. And be honest with yourself. Like, how many guys have that employee that you hired at 65 grand who's now making 95 grand, and you kind of shook his hand in his review meeting and you never actually papered it properly? Certainly we had a bunch of those. So cleaning up that admin side would have saved us a bunch of grief. Instead, it was just grief. But the fun side is on maximizing value. And you think that you get, it's just say like an EBITDA multiple of 10 if you throw that out there, whether it's 5 or 10, 15, it doesn't really matter. We didn't think about EBITDA prior to selling. We thought about cash in our pockets, right? What do we have in the bank at the end of the year? What do we need in the business? Okay, easy, right? If we had thought about EBITDA beforehand, we would have been able to go back and say, with a mid-market company, so much of your personal life is intertwined back in the business, right? The public guys here probably doesn't apply, but when you're mid-market, you're co-signing and stuff. We're all putting through a lot of expenses there that may not go through otherwise, right? But being able to then say, hey, here's my true EBITDA, here's my normalized EBITDA, and here's why I should get a multiple on that. Take salaries. We cut our salary a few $100 grand right before selling, so we said, here's our pro forma. Yeah, no, here's what will be the true cost of hiring us, right? We've paid ourselves that, but here's our real, you save, 200 or 300 or 400 grand in salary, you multiply that by 10, that's some real numbers there in terms of the valuation. Now, you've got to sell the guy on it, of course, too. They're not idiots, but still, if you don't at least take a chance, they're not going to give it to you. So I kind of think of it almost like looking at how an outsider buyer would view the business now. Any business I want to get into, even if I'm never going to sell, it's actually, I believe now that it's better to run my business looking at it like we're going to, if that makes any sense. So we got through this process, it was all crazy. We got to the end. And one last story here with my partners. And in closing, we were all pissed off about something. I don't even remember what it was, but we were all negative, and we were at this like, we're going to walk away phase. The good and the bad. But we did one thing prior where we all separately went and wrote down how far do we think we could take the business, you know, what would we settle for, what do we want out of this, and actually wrote that down on paper. So when it was really tough and we were sitting there and we're ready to walk away, and we said, no. 6 months ago, this is what we were thinking. You know, we were here, here's where we are now. Here's where we thought we could take the business. You know, we've been telling people how great we are for the last 6 months, and you can start drinking, drinking the Kool-Aid yourself. You know, that acted as a sanity check to say, hey, this is the right choice, and so we pulled the trigger. So if I bring this all together, on the fundamental side, I got recurring revenue. We focused on the U.S., these soft competitive advantages. For us, it was SEO and being low cost in terms of how we use technology, kind of twisting the business more around. Pricing, especially in the early days. Being in an industry with good fundamental economics. On the deal side, it was running a good process, rigorous, create a bidding war, having a great investment banker who could negotiate, being prepared to walk away, the tax side, and exit planning. And as I've talked about these 10 things and these two sides, they really are intertwined. And you know what my conclusion after going through it is that they're really related to each other. They're symbiotic. I mean, you can't run a good deal process unless you got some substance on this side, right? You know, you can't just fool everybody. Well, most of the time you can't fool everybody. If you're Instagram, you can fool everybody, right? You can get $1 billion for nothing. But if you have a great business on this side, unless you actually run a good process and you run a good deal, you're not going to get that multiple, and you're going to leave all out on the upside. So it's really about, to me now, bringing these all together. So if I could sum it up in one final message, you know, my experience and the way that what I've learned is that, to me, the best combo is to be able to provide that financial discipline of an investor with the common sense and that gut feel of an entrepreneur. And so for me, that's what's maximized value. Thanks.